Have you ever felt like no matter how hard you work, your money never seems to catch up? You put in the hours, save what you can, and maybe even invest a little. But the growth feels slow. The truth is, wealth doesn't build in a straight line. There's a point where money stops crawling and begins running on its own. It's the stage where your money works harder than you do, and it's what I call the wealth curve. Understanding this curve changes everything, because once you reach it, the effort shifts away from your daily grind and onto the power of compounding and smart investing. The wealth curve isn't about luck or chasing quick wins. It's about reaching the point where the numbers start to lean in your favor. At the start, building wealth feels heavy. Every dollar saved or invested barely seems to move the needle. But over time, as your base grows, compounding gains momentum. The money you've built up starts producing more money. And when that income from investments becomes significant compared to your own labor, you've stepped onto the wealth curve. That's where financial freedom begins to take shape. Let's put it in perspective. Imagine you have $1,000 invested and it grows by 10% in a year. That's 100, not life-changing. You're still the main engine powering your finances, but if you've grown your portfolio to $100,000, that same 10% return is $10,000. That's no longer pocket change. That's months of living expenses covered without you lifting a finger. Push it further to $500,000, and 10% means $50,000 in a single year. At that point, your investments are generating income on par with a full-time salary. That's the curve. At first, compounding feels invisible. Then suddenly it feels unstoppable. The mistake most people make is giving up too early. They save for a while, invest a little, and then stop because they don't see big results right away. They don't realize that wealth grows slowly at the start and then faster and faster after crossing a certain threshold. This is why so many people underestimate compounding. They expect it to feel powerful with small sums when in reality, its true strength only shows once you've built up a solid base. That's why the first $100,000 is so critical. It gets you onto the curve where money begins pulling its own weight. Think about your own journey. In the beginning, every dollar saved feels hard-won. You cut expenses, skip luxuries, and put money aside. It can feel endless because you're doing all the work and the money isn't producing much in return. But if you stay consistent long enough to reach the point where investment income becomes noticeable, something changes. The pressure to work nonstop eases because you've built a second engine. One that doesn't tire, doesn't take breaks, and keeps running day and night. That's when wealth truly begins compounding in your favor. The wealth curve is not just about hitting a number. It's about shifting from active effort to passive growth. Once your investments generate a return that rivals or even surpasses what you can earn with your labor, the game changes. You no longer have to trade all of your time for money. Instead, you start trading patience and discipline for exponential growth. This is why the wealthy talk about letting money work for them. They've reached the curve, where the compounding effect finally outweighs the need for constant hustle. To reach this stage, there are two main levers you can control: how much you save and how consistently you invest. The math is straightforward. You can't expect compounding to do the heavy lifting if you haven't given it enough weight to work with. A snowball only grows once it has some size. That's why the early stage of wealth building feels slow. It's you pushing the snowball uphill. But once it reaches a certain point, gravity takes over. The snowball rolls on its own, gathering more with less effort from you. That's the wealth curve in action. A good way to think about this is by comparing two people. One saves $500 a month and invests steadily. Another spends everything and invests nothing, waiting for the right time. The saver may feel like progress is small at first, but after 10 years, they've built up tens of thousands in assets. At that level, compounding starts producing thousands in growth each year. Meanwhile, the non-investor is still stuck at zero. The wealth curve rewards the patient and disciplined, not the ones waiting for a perfect moment. It's also worth noting that the curve doesn't just come from investing in stocks or funds. It shows up in business, real estate, or any asset that generates returns. A rental property that pays you monthly income, a business that produces profits even when you're not directly working, or dividends from stocks all contribute to this curve. The key is building assets that keep producing value. When those assets reach a certain size, their returns become powerful enough to surpass your own daily effort. That's when money truly starts working harder than you. But here's the catch. Most people never stick around long enough to feel the curve. They dip in and out of investments, pull money out when the market drops, or spend every dollar they earn. They interrupt the compounding process before it has the chance to show its strength. Think of it like planting a tree. In the first few years, it barely grows. If you get impatient and chop it down, You never get to see the shade or fruit it could provide in the future. The wealth curve rewards those who let the tree grow, water it regularly, and wait for the payoff. One of the best signs that you've reached the curve is when your investment returns start covering real parts of your life. Maybe your dividends cover your grocery bill. Maybe your rental property pays for your transportation. Over time, the returns can cover larger expenses: housing, healthcare, travel, even retirement. At that point, your financial life feels lighter because you're no longer solely dependent on your labor. Your money is carrying a share of the load. Another key aspect of the wealth curve is that it builds confidence. When you start seeing your money work for you, your perspective shifts. Instead of constantly worrying about making ends meet, you start thinking in decades, not days. You make decisions based on long-term stability rather than short-term survival. That's when you realize wealth is not about sudden windfalls. It's about patiently building until the curve takes over. The beauty of the wealth curve is that it doesn't require genius or extraordinary luck. It only requires consistency, patience, and discipline. You don't need to predict the stock market or invent the next big company. You just need to stay the course long enough to let compounding reveal its true force. The earlier you start, the sooner you hit the curve. And once you do, life feels different. Your money isn't just sitting there, it's running on your behalf. So, where does this leave you today? The real question is not whether the wealth curve exists. It does. The question is whether you're positioning yourself to reach it. Are you saving consistently? Are you investing in assets that grow over time? Are you patient enough to let compounding work without interruption? These are the habits that determine whether you'll still be pushing your financial snowball uphill, or whether you'll step onto the curve where it rolls on its own. At the end of the day, the wealth curve is the difference between working for money forever and letting money work for you. Most people will never feel it because they give up in the early, invisible stage. But those who stay the course, keep building, and trust the process eventually discover the curve. And once you're on it, there's no going back. Your money becomes the hardest working asset in your life. The beauty of this curve is that it doesn't demand perfection, just persistence. You don't need the biggest paycheck, the flashiest investments, or a perfect strategy. What matters most is staying consistent long enough for your money to gain momentum. Even slow, steady contributions eventually turn into something much larger than you could have built by effort alone. Think of it this way: the earlier you start, the sooner you'll feel the curve picking up under you. And if you haven't started yet, the next best time is today. Every decision you make from this point forward, whether to spend or save, consume or invest, decides how quickly you'll meet that turning point. The wealth curve is waiting for anyone willing to stay disciplined, and the sooner you begin, the sooner money starts doing the heavy lifting for you. Every dollar you save and invest early becomes like an extra worker on your team, quietly adding effort day after day. At first, their impact feels small, almost invisible. But over years, those tiny contributions compound into something massive. And suddenly the growth feels effortless. That's why timing and consistency matter more than quick wins or chasing shortcuts. You don't need the perfect investment, and you don't need to predict the market. What matters is that you start, you stay the course, and you avoid interrupting the process. Because once the curve tilts in your favor, wealth stops being a grind and instead becomes a natural outcome of the work you've already done.